I'm Danielle Wood. I'm CEO of the Grattan Institute, and I am coming for this webinar today from Boomerang country. I would like to pay my respects to the elders of this land, past, present and emerging, as well as the elders on all the lands from which people are dialing into this webinar today. This of course has been a very big year for public policy in Australia, and most of the discussion has understandably focused on the here and now. What's the right strategy for suppressing coronavirus? How do we keep households and businesses afloat? How much stimulus do we need? But I'm very pleased to say that at least some of us can walk and chew gum at the same time. And while these debates have been raging, important long-term thinking has continued. One of those areas where it is most evident is the thinking about the future of our retirement income system. Discussing the retirement income system and how well it's serving Australians can be challenging. There are lots of different ways into the debate. All of us have skin in the game, and there's often claims and counterclaims which can make it confusing and unsettling for many. That's why I thought it was fantastic that the government commissioned an independent panel to conduct a review of the system. The review wasn't there to make policy recommendations, but to establish a fact base to inform Australians as well as future policy discussions. The review tackled head on many of the questions that actually came through when we asked for questions for this webinar. How much should Australians save for their retirement? Are they saving enough? How much are pension costs going to rise as the population ages? What happens to Australians that are renting in retirement? I am delighted to say we're joined to hear some of the answers to these questions and probably many more by one of the members of the Independent Retirement Incomes Review panel, Dr. Deborah Ralston. In addition to her work on the panel, Deborah is a professorial fellow at Monash University, a member of the steering committee for the Melbourne Mercer Global Pension Index and the YBF FinTech Advisory Board. She was the principal investigator of the CSIRO Monash Superannuation Research Cluster and inaugural chair of ASIC's Digital Finance Advisory Committee. In 2018, Dr. Ralston was appointed to the Comprehensive Income Products for Retirement Framework Advisory Committee. There are a lot of big names in this space. Deborah is going to be joined in discussion today by Brendan Coates. Brendan is the director of Grattan's Household Finances Program. He's done a huge amount of research on retirement incomes policy over the past 5 or so years, and that sits next to a broader set of research work on tax reform, economic and budget policy, housing, macroeconomic policy and immigration. He previously worked as a macro financial economist with the World Bank in Indonesia and Latin America and with the Australian Treasury. I cannot imagine 2 more knowledgeable people to talk to us about the retirement income system in this country. So we're going to kick off today with a short presentation by Deborah about the retirement income review and its key findings. I'm then going to moderate a discussion with Brendan and Deborah about the findings and what it means for retirement incomes policy in Australia. If you have questions that you would like me to put to Deborah and Brendan, please put them in the Q&A and I'll try and get to as many as I can during the conversation. After having done a few of these, I would say you have a much better chance of getting your question put if you go early. Don't get caught in the rush at the end. I'll now hand over to Deborah, who's going to talk to us about the retirement incomes review.
Thanks very much, Danielle, and it's a pleasure to be here talking to you today. I'm just going to do a quick few slides because this is a huge report. It's something like 460 pages, and I'm sure that not all of the audience have read the whole report. So it just makes sure we're on the same page at the same time. So Beatrice, slides, please. So let me just talk to you briefly about what the review is and what it isn't. It was commissioned by the federal government on the basis of a recommendation from the Productivity Commission. And what we're really asked to look at is the retirement income system, which has as its core the age pension, compulsory superannuation and voluntary savings, which includes home ownership. What the review seeks to do is to establish a fact base on the current retirement system to improve understanding of its operations and outcomes. And it's really important to remember that we're not actually making recommendations in this report. What we're doing is we're laying out the evidence base so that we can have the debate, we can inform all Australians, and we can inform industry people, and we can also inform government and policymakers. What they wanted us to look at was how the retirement income system supports Australians, the role of each of those pillars, And very importantly, distributional impacts right across the economy. There's a huge diversity of people's experience out there, and we needed to make sure that there was some equity across that. And also to look at the impact on public finances of current policy settings. So we commenced this review in September 2019 and reported to the Treasurer in July 2020. So we had about 10 months. And believe me, we really needed them because, as this slide demonstrates, it's quite a complex system. We called for, we put out a discussion paper and called for submissions in November of last year, and we received over 430 submissions. We had discussions with 100 different groups or individuals who had an interest in this, and we commissioned a lot of research. So when we looked at this system, we've got the 3 core pillars there. We've got the age pension, compulsory super, and voluntary savings. But all around it is quite a system. There's the tax system, which impacts. There's the transfer system, particularly things like Commonwealth rent assistance. And very importantly is probably what I would tend to call the 4th pillar, which is social transfers in kind. And I think we underestimate the importance of that as we grow older. But I guess what I want everyone to take mostly from this side is it's not another super review. It's a retirement income system review, and it's really looking at how that impacts on Australia now and into the future. Next slide, please. Because it's such a complex system and because there's such a diversity of individuals involved, we decided to develop a framework to look at different aspects of the system. Firstly, adequacy. Are people getting enough income in retirement? Secondly, equity. That's all of those distributional impacts I was talking about. And we looked at an enormous range of differences in wealth, gender, disability, home ownership, the age at which people retire, particularly looking at involuntary retirees, Aboriginal and Torres Strait Islanders. So under equity, we wanted to know what those outcomes were. We also looked at sustainability. In many ways, sustainability is the reverse to adequacy. You can have a very adequate system, but it may not be sustainable. And on the other hand, a very sustainable system may not be sufficiently adequate. So we have to balance those two things. And finally, we looked at cohesion, which was really about how the 3 pillars of the system work together and how well the system is understood. Next slide, please. So very briefly, we decided that under adequacy, 2 really important things. Firstly, there should be a minimum standard of living for retirees with limited financial means consistent with prevailing community standards. And you can see that that pretty much describes the age pension. And the second part of adequacy is about a system that facilitates people to maintain their standard of living in retirement. And you can relate that to superannuation. That's about income smoothing. When you're earning money, you save some so that you can enjoy a fuller life in retirement. We looked at equity. We wanted to make sure that the system is targeting those people who need the most support. And we also wanted to make sure that we're achieving similar outcomes for people in similar circumstances. Next slide, please. Under sustainability, we wanted to know if it's cost effective for taxpayers. There is a bit of an intergenerational bargain. One generation supports the generation above, and in return, the next generation coming through does that. But we needed to make sure that it's not an unreasonable burden for current or future taxpayers. Secondly, and particularly important at this time, because as you can imagine, COVID arrived in the middle of our review, and there were lots of issues about how do we ensure that this is a sustainable system going forward and robust to lots of economic and other changes. A lot of sensitivity analysis required there. And finally, on cohesion, we wanted to check if the system had sufficient incentives to smooth consumption and support people to take personal responsibility for their retirement. Secondly, we wanted to know about how well that core, the three pillars we were looking at, how well they relate to the rest of that very broad system. And we felt that the system should not be unnecessarily complex for consumers, which was the mainstay of where we were going. So very briefly, that's what we were trying to do over the 10 months of the report. And that report was released just a couple of weeks ago by the Treasurer. So to just emphasise again, it's not a super review, it's a retirement system review, and it doesn't make a recommendation, it just sets out all the facts. Thank you.
Fantastic. Thank you so much for that overview, Deborah, and congratulations to you and the panel and the Secretariat team. It's an absolutely huge undertaking to sort of cover off on such a complex system in 10 months, and it's obviously an incredibly important document. Taking the bird's eye view after doing that big process, how would you say as a whole the system is faring?
Well, what we did find is that the Australian retirement income system is effective, sound, and its costs are broadly sustainable. And as you mentioned in the intro, I've been involved with the Melbourne Mercer Global Pension Index since it started. I think actually now it's the Mercer CPA Global Pension Index 10 years ago. So I'm not particularly surprised on that, because we do stand up pretty well when you put in international comparisons. But we did find some flaws and some things that we think need better attention. So overall, it was a fairly good mark.
And as you said, this wasn't a superannuation review, this was a retirement incomes review. And often we just sort of end up talking about superannuation. So I wanted to come first actually to the age pension. How do you think about the role of the age pension in that overall system?
Yeah, I think it's one of the little stars in our armament, so to speak. And it's something we don't ever talk about very much. It's just something that's there. And it's actually, we said we have to make sure that people get a minimum standard of income consistent with community standards. And actually the age pension has grown faster than wages over recent years. It is a very satisfactory level of income for most people, with a couple of exceptions, particularly renters and early retirees. And we'll probably talk about that a bit more. But it's very dynamic also. We tend to think, 65% of people are on the pension, but actually 45% at the point of retirement, and by the time you get to 80, about 80%. So it's a buffer as your resources run down and you get older, or in a period like this where returns fall. That is a safety net to make sure that people can maintain a decent standard of living in retirement. And it's also got an incredibly important role in providing equity in retirement. Many people who retire with very limited superannuation balances, when you factor in the assets test and the standard of the pension, it reduces the gap in earnings. So if you think about women, for example, and the gender gap in wages, which for a full-time person, the difference between male and female wages is about 17%. When they get to retirement, the age pension kicks in, so the retirement income gap in retirement is only 8%, because you've got that moderating influence of the age pension. So it's a very clever piece of work.
Fantastic. I want to come back to that gender gap in retirement, because we have had a question come through on that. But while we're still covering off on the age pension, I'll bring you in here, Brendan. Something that I was really struck by in the review was the survey that was undertaking, suggesting less than half of respondents thought that the age pension would exist when they hit retirement age. It's a pretty striking figure. Where do you think this perception that the age pension is going to disappear is coming from?
Thanks, Danny, and thanks everyone, and thanks Deborah for participating in the webinar. I think it's a really good report, and I'm really looking forward to discussing it. So first of all, I think let's look at the numbers about what the review says about the age pension itself. Like, the review says that age pension spending is actually going to decline over the next 40 years, and that's despite an aging population, So there is this belief amongst I think it's actually a belief that's shared pretty broadly. It certainly was the belief of my parents' generation who thought the pension wasn't going to exist until they retired. And a lot of them, in fact, became eligible for it. And the findings in the review, the survey work that's been done by the Behavioural Insights team for the review, essentially says that most people, more than half, think that the pension won't exist in future. And amongst those that think it will exist, it won't be worth what it's worth today. Now, that view, I think, is framed by the fact that we have an ageing population. There's been a series of intergenerational reports that have said, particularly the early ones, said pension spending was going to rise really sharply as a share of GDP. Therefore, it's going to become more of a costly burden as there are more people of pension age for each person who is of working age in Australia, and that was potentially going to be unsustainable. I think it was reinforced perhaps by the way that superannuation was framed. Not necessarily by Paul Keating and some of the architects, but it's been a pretty pervasive story about superannuation since since universal compulsory superannuation was established in the early 90s. That part of the rationale was arguably that it was about getting people off the pension. It certainly comes up, in almost every media interview I ever do about superannuation. The frame is often, is super getting people off the pension, as opposed to probably what the right answer is, which is super, together with the age pension and other savings, making sure people are saving enough for retirement. And I think the review really rebuts that claim really clearly. So pension spending is going to fall from 2.5% today of GDP today to 2.3% in 2060. Interestingly enough, if compulsory super does or doesn't rise to 12%, which I'm sure is an issue we'll talk about today, this is a Grattan webinar after all, then the impact on the pension spending barely changes. So pension would be 2.4% of GDP if super stays at 9.5%. It's 2.3% if it does go to 12%. I think it's something that we actually need to put to bed, is this idea that the pension's going to disappear. I think the review shows that the system's working really well, and also that it's quite there's a strong political constituency in support of it. So the average age, the share of Australians that are aged over 55 is rising sharply. A consequence of that is the share of the Australian electorate that is over the age of 55 is also rising pretty quickly. And I find it hard to see how a political constituency that would emerge to say that we should have less pension in future, that we should cut the rate, or that we should more tightly subscribe or prescribe access. And so I think the pension's probably here to stay, and I'd suggest that's probably a good thing.
I imagine a lot of younger Australians would also be of that view as well. So look, I'm sure that's reassuring for people that are listening.
No, I think it is a real concern too. One of the things that we know is that people have enormous anxiety about retirement and whether they'll have enough. And their understanding of the role of the age pension is pretty limited. So it's concerning if people have an anxiety on that count.
Yeah, that's exactly right. Well, let's talk about how much is enough now, Deborah. And this was probably the most common question that came in before the webinar. How did you go about, in the context of the review, thinking about what was an adequate income in retirement?
Yeah, for sure. Well, the thing that we really noticed when we commenced this is, as I said before, a huge diversity of experience. So we looked very carefully at income profiles, and really, when you look at that, there are three groups that tend to fall out. There's the lower income people, that's the bottom 30% on less than about 48,000 a year gross. Then there's the middle group, and the middle group is where a lot of policy is directed, because they're the people who do have the capacity to save. And then you have the top 20%, which is people earning more than 112,000 a year, and we tend to call them the higher income group. So when you look at what's an adequate living standard of living in retirement, it's kind of complex, because if indeed superannuation is about income smoothing, well, if you don't have much income while you're working, that's kind of hard to think that you're going to have a lot of money in retirement. So it has to balance working life income, retirement income. So there's two primary ways to go about this, and the first and very popular one that was suggested by quite a few stakeholders and is quite commonly used is the ASFA comfortable standard. And it has one great advantage in that it's very simple. It's kind of just one measure for everyone. But the disadvantage, of course, as I said, is it doesn't really suit all income groups. It was originally designed for that top 20%, the self-funded group, and for them it works really well. But for the other groups, not so well. So if you think about the breadth of people, for people in their working life, about 70% of singles and about 60% of couples don't have that much disposable income in their working life as the comfortable standard is suggesting. So you're creating a pretty unrealistic assumption that they're going to be able to achieve that standard of living in retirement. We relied on a relative measure, which is a replacement rate measure. Now, if you're in the, and normally what we'd say a benchmark is certainly for all of the middle group, try to think about 65 to 75% of your working life income as being your basis for retirement. You have fewer expenses in some ways. You tend not to have children at home, you tend not to be paying off your mortgage, and you tend not to be saving for retirement because you're there. That's the kind of replacement rate. But having said that, at the bottom end, when you've got that lower 30%, they're probably going to be looking for about 100% replacement rate. And the age pension plays a critical role in that. On a top 20%, as I said, the Astra Comfortable is good there. And it also means they probably only need to bargain on having around 60% of their retirement income because they have a lot more disposable cash in that area. So it's very much horses for courses, which is probably where a bit of guidance to people about retirement income is very useful.
And if we take those benchmarks that you just discussed, Deborah, how are we going, both for current retirees and in terms of where you think the kind of current group of pre-retirees might be in the future?
Yeah. Well, it's actually looking very good, except that we do have one problem, and that is that because most of our superannuation has been in the accumulation phase and we're very much focused on that, we tend to think about the nest egg, and people are quite reluctant to draw down. It's that old feeling that you need to be careful, just spend the interest and the dividend, don't touch the capital. And that's a bit where it falls down, because the whole purpose of amassing a super balance is it's there for you to use through retirement. So we do find that quite a few people are living very frugally indeed, frightened to touch their capital because they're concerned about the future. And it makes perfectly good sense in one way. We've been taught to save and to look for the future and all of that, but people tend not to factor in the benefit of the age pension, and also what I referred to before as the fourth pillar, the social transfers in kind. In quite a few countries, when they model retirement expenditure, it's steeper in the early years of retirement, it falls, and then it increases again at the end because people need money for healthcare and aged care and stuff. In Australia, it's not like that. It's kind of a constant downward expenditure thing. So a lot of this anxiety about will I have enough is not necessarily well-founded in our system. So we need to make sure people are better informed about what's available to them once they reach retirement.
Yeah, interesting you raised that, because we have had some comments coming in on that, including one from Richard Lambert noting that him and his wife are self-funded retirees. They're not drawing down as much as maybe you would like them to because they're uncertain about longevity and aged care costs.
Yes.
Are those the most sort of common reasons that you see people being reluctant to draw down?
Yeah, I think that's very, very true. And I think that what has happened is that we have kind of got this mindset that we grow those savings, and it feels almost negligent to take your capital out. So, you know, these are areas where a bit of advice is very useful to people to give them more confidence. And the funny thing is I've worked a little with Australian Super over the years on a retirement confidence index, and they've just produced the 4th year of that, and it compares retirees versus pre-retirees. The very interesting thing is pre-retirement, people are incredibly lack confidence about how they're going to cope. Once they get into retirement, they tend to be more confident. But nevertheless, because they find the system's not so bad after all, but I think that the concern Richard expressed is one that people do share, and that's a real challenge for us to get together and think about how we can make people feel more comfortable about spending down their retirement savings.
Brendan, I might bring you in on that issue. How do you think we might think about that issue of getting Australians to draw down on their retirement savings more? I know when Paul Keating was asked about this, he said, you can't eat your house. Can people eat their house, or what are the other options that are available to them?
Well, look, Danny, Paul Keating remains a wonderful wordsmith. I think his one-liners are, they do go to the heart of some of the challenges with the system. So first of all, as Deborah said, we think about what are the drivers of why people aren't drawing down their savings. It does seem to be on our work, and it feels like this is reflected in the review as well, that big concerns about health and aged care costs, as Deborah mentioned, are really big things. Now, with healthcare, government is actually on the hook for almost all of it in retirement, with probably less so for the top 25% of the earnings distribution. People who have got private health insurance are spending a reasonable amount on that, which essentially allows you, if you need elective surgery, to jump to the front of the queue. But for most things, government is in fact paying almost all of your healthcare costs. Your scripts on the pharmaceutical benefits scheme are $5. Your trip to the hospital is normally free. Going and seeing your doctor is, heavily subsidized. So people expect they're going to need to have those costs, and they don't need them. I think the answer is probably reassure people that the universal social safety net of healthcare is available to them in Australia and will continue to be so, as it has in Australia for the last 20 to 30 years. On aged care, I think there is a particular aspect of the design of the system that really hurts the degree to which people draw down. So most people, if you ask them, what do you need money for aged care? The answer is typically, I need a bond in order to pay my way to get into an aged care facility. And that bond is substantial. In a lot of cases, it can be $500,000, $600,000. But the reality is how we're funding aged care is actually already changing, because that bond is essentially a prepaid bequest. The aged care facility doesn't get the bond and keep it. They get to live off the interest. They get the interest on that. They invest and they get the interest on that for the period in which you're in that residential aged care facility. As soon as you leave, typically because people are passing away, that is essentially going to your estate. So it's more or less a prepaid bequest. We've been moving away from that system. So some of the reforms to aged care mean that we're now spending, fewer people, I think less than half, are now putting their money to secure a residential aged care facility are paying that bond, because you can instead pay a daily rate, just, a fee for service. But the issue is that people don't interact with the aged care system very often. They interact normally when their grandparents go in, then when their parents go in, and then when they eventually go in. And there's typically 30 years between these events. So I think the reality of the aged care bond has not been reflected. The changes there have not been reflected in community perceptions. Beyond that, those two big ones, there are risks of outliving your savings, although those risks to a degree are protected by the age pension if you're a middle income earner, because you'll get, if you draw down your savings, instead of getting a little small amount of the part pension, you'll get a much larger amount. And in fact, the reviews, all the sensitivity analysis the review did shows that the pension provides really substantial insurance against longevity risk. So there is a push. It's been recommended before in the financial system inquiry that we should move towards mandating people to be in products that protect them against the risk of outliving their savings, things like annuities. Look, that's something that's worth exploring, but I think you've got to be very careful about how you do it, because those products are quite complex. I can explain an account-based pension to my parents. Basically, you get to take out whatever money when you retire, subject to the minimum drawdown rules. Trying to explain an annuity or a deferred lifetime annuity, or there are a host of these other things, is very hard. And so I think you've got to be careful about making sure that if you're going to default people into those products, even a soft default where they can opt out, that the markets are actually going to work, because I'm not 100% confident that they will, because I don't know if people will really understand what they're buying. And when people don't understand what they're buying, and the motivation around the whole exercise is fear, you can get some really bad outcomes, as we have with a tail of poor performing superannuation funds in the accumulation phase.
I've got to say I've got a bit more optimistic view than you. I'm really looking forward to the retirement covenant is due to be introduced on the 1st of July 22, which means that superannuation funds will then have to guide people through retirement. And I've done quite a bit of modelling in this area, and the two really big anxieties I think in retirement are A, running out of money, and also the volatility of markets. So if you structure a product appropriately, I'm not sure they have to understand the complexities of those products, but you can offer a package and say, we can guarantee you, well, let me take the word guarantee out. We can assure you that you will have approximately $45,000 a year. It might vary by 5 or 10%, but you will have that through to the rest of your life. You won't run out of money, and that money will be there for you, so you can plan for your spending and you don't need to conserve at every step. There are some clever ways to do that and some good products, and what we are going to see is a lot of innovation in this market, because I think they're the things that you really need to know. I don't want to run out of money, and I want to know that that money is not going to vary too much over time, and I also need a bucket of money for any capital item that I might need, and for some people, a small bequest. So you decide on how you have that money, but you structure your retirement income around that. And I'm very bit more optimistic, I think, than Brendan. But, you know, it's not without complexity, but making sure that retirees have confidence to live a good life is really important.
It's interesting you raised confidence there, Deborah. I'm just going to, this is a comment from one of our webinar participants, Marcus Wigan. He's 80 plus, or the 80 plus age group as he describes it. And he says he's conserving his super because he's worried about government changes based on past behaviour. So perhaps a bit of a call there for some stability in the settings around retirement. I just also wanted to pick up something else you said there towards the end, Deborah, on bequests. You know, how big do you think that bequest motive is in people sort of saving rather than drawing down in retirement?
What the research shows is that the bequest motive is declining a little bit with generations coming through, and it's not as strong as it used to be, and there's nothing wrong with wanting to leave a bequest. However, what's happening now is people aren't necessarily intending to leave this money. It's just that they haven't spent it and it's accumulated towards the end of their lives.
That's really interesting that we're seeing that sort of generational shift in attitudes.
Do you know, this is a very interesting fact, that people who retire now on an annual basis will spend about 40% more per year than people who retired 20 years ago.
Wow.
So things are changing, yeah.
The baby boomers are living it up, which is good. They should be.
and Marcus is being very sensible and careful. I think you can see a little bit of a change coming through there.
Interesting. Well, we do see sort of differences in a whole host of different attitudes across generations. So it's not surprising that each generation will sort of take its own approach to retirement as well. I'm going to come to Brendan's favourite question now, or certainly the other one that we end up talking about a lot in these debates, which is around compulsory superannuation contributions. We had some questions come in pre-webinar about whether the review has shifted your thinking at all, Brendan. You've previously come out against any further increases in superannuation guarantee. Has the position changed, and what information sort of did you find particularly useful in the retirement incomes review?
Thanks, Danny. It's funny. I don't think the rate of compulsory super is my favourite retirement income question, but it's the one that I always end up talking about, which I think reflects the state of our public discussion around superannuation and retirement incomes. I think, as Deb said, this is a retirement income review, but the conversation almost inevitably goes to the rate of super. And, you know, Grattan has had a well-established and, you know, a quite clear position. We don't think those increases were unnecessary. You know, I think it's worth stepping in and asking, well, what's the point of compulsory super? And I think the review makes really clear the compulsory super helps people to save more than they otherwise would, that it overcomes behavioural biases that would otherwise see people not save enough, particularly in those middle income bands, and that therefore having a compulsory system, in my view, in my interpretation of the review is endorsing that idea of compulsion. As to the rate, well, it comes down to the questions are always, are we forcing people? You got to set the rate somewhere. And so the question is, how are we balancing that trade-off between working life and retirement? Are we setting compulsion at the right level? Noting that we have a single rate of compulsory superannuation, an incredibly diverse population, and also that's entitled to different levels of the age pension, either a full pension at the bottom, a part pension probably in the middle, or no pension at the top. And so you're setting the rate of super in order to do the most good for the most people. So there's trade-offs at the heart of this. And what my reading of the review is, the review broadly finds that, if the benchmark replacement rate they're aiming for is 65 to 75% of your pre-retirement earnings, the baseline replacement rate, if super goes to 12%, I think is 87%. So it's higher. So it's probably a bit on the high side at the median. It obviously falls as you go higher up the income distribution. And that therefore, I would see what the review's done is really, suggesting that a number of something like 9.5, 10% is probably enough. The review does not make recommendations, but I think facts sometimes speak pretty loudly. The thing I also thought was really interesting in the review that I really valued is that we're having a conversation about the fiscal costs of superannuation, what the impact is of the budget of going to 12%. And what the review does is it shows with its costings, it's kind of got access to the Treasury's modelling, that if you go to 12%, the tax breaks, the extra foregone revenue for the government is larger than the pension savings for 35 years, out until 2055. And then you've got this 35 years of accumulated debt you've got to pay back. So while it's not the main purpose of super, a subsidiary purpose is often claimed to be, it's about protecting the age pension and making the system more sustainable. I'd say a fair reading of the review is that it suggests that higher super probably costs the budget more than it saves, certainly for about 50 years. And normally you'd probably want a fiscal return in less than 50 years if you're going to do something like that.
I want to come back to that fiscal question, and I'm going to put it to Deb because I think it's important. But if I can just go back to the first part of what you were saying, Brendan, sort of implicit in that when you're talking about the trade-off between current and future living standards, you're clearly assuming that super is coming out of people's pockets. Another way of saying it is that super is coming out of wages. I'm interested in your response to that proposition, and I'll just put the counter argument straight away. And this is sort of the Paul Keating argument, and I did see it come through in one of the questions as well. Even if you sort of believed in the past that super came from wages, in the current environment where wages aren't growing, is the super increase going to be the only way that people see an increase in their incomes? In other words, if we stop this super increase, are we denying people their only chance of a pay increase?
Yeah, I think this framing is really interesting because it denies the idea of there being some counterfactual, there being some other reasons other than the SG as to why wages rise or don't rise. So, what we did in our work, our No Free Lunch paper, essentially the Reserve Bank has affirmed that work in suggesting that roughly 80% of super comes from wages within 2 to 3 years, is that you're essentially looking at, okay, controlling for everything else that affects wages, what's the impact, what's the difference between those periods when superannuation increased in the past and when it didn't? And, the clear implication from our work is that when superannuation is going up, the rate of compulsory super rises, then wages growth is slower, to the tune of roughly 80%, at least 80% within that 2 to 3 year period. What the review found, or at least the review had commission work by ANU that found something pretty similar, that when superannuation goes up, looking at what happens to wages tend to grow more slowly after looking at all the other things that affect wages. So I think you often hear this claim that wages haven't risen since the SG was frozen in 2013, and so the super doesn't affect wages. And, it's a claim we often hear, but I think it's based on a misunderstanding that the only thing that affects wages is superannuation. And that's clearly not the case. The growth in wages depends on a whole host of factors, like the state of the economy, productivity growth, industrial relations. It's why we're having a debate in Parliament or the public debate about industrial relations changes. And so the question is, what happens to wages when the SG rises after those other factors? And I think the evidence is pretty clear. And the evidence, you should think of it this way. There's nothing in the mechanism of high compulsory super that compels the employer to actually give a higher wage to the worker. You've got two bank accounts. One's going to the super fund, one's going to the worker. If a business is not willing to offer wage rises even before the compulsory super rises, why are they going to wear that cost into the bank account of the super fund of that fund member and still get the same pay rise they were going to give previously and wear that extra increase in cost? There's nothing in the mechanism that compels that to happen. And when wages are still growing, now they're growing really slowly, but they're still positive. It seems, as we've seen in the past, pretty compelling to me that you'll see wages grow more slowly if employers are forced to put more into that other pot instead.
I would love to see a Paul Keating, Brendan Coates debate on this, I have to say. I'm just going to do a quick shout out. There's a number of people in the chat making the point they don't like the term retirement, or they would like a new term for retirement. That retirees are making a big contribution to Australian society and the economy, just in different ways than they were before. And I think those are really important points to acknowledge. Deb, I want to come back to the adequacy question. And even though, as you said, you did find that most people are on track for an adequate retirement, there are some groups that are struggling, especially renters and especially people that retire involuntarily. How big did you find those problems were?
I think the issue of people who don't own their home and who are renting is really quite a big one. And we looked at the transfer payment, the Commonwealth rent assistance that helps people on social security to offset their renting costs, has been tied to the CPI for some time. And as we all know, the cost of housing has really accelerated over recent years. So the CRA no longer really represents the value of renting. So even when we increased that by 40% to bring it back to an index value, we found that it does help people obviously to increase their rent assistance, but it's not the total solution. And the issue is much wider than the retirement system. And there are a few things like that are wider than what we could specifically look at. So we would certainly think that increasing the CRA was a good conclusion to come to. But at the same time, that won't solve the housing cost issues. So they're a real concern to us, people who are renting. It's about 12% of retirees. So it's and usually they're in the lower income area. Interestingly, the Commonwealth rent assistance goes, 90% of it goes to, I think, the smallest fifth of the population, the lowest income fifth of the population. So it's very targeted. So we need to think, and that's a bigger issue than what we could handle. But clearly, we've demonstrated that we need to do something about that. Secondly, involuntary retirees, and this is a group that I have done quite a bit of work on before, and I have a lot of concern about people. If you've been a manual worker for 40 years, quite often you might find that you don't last through till 65 or 67. So those people at the present time are pretty much stuck on job seeker support, which is significantly less than the age pension. And sometimes they're on a disability support, but that's been tightened up enormously over time. So for that group, they are the second group, the renters and the involuntary retirees who are at risk of being in poverty. And I saw one of the questions there said how many people are in that category, and it's a surprisingly high percentage. And in 460 pages, there are a lot of statistics. I can't specifically remember the statistic, but it is something like 30% of people don't make it right through to full retirement age. So it's a very significant cohort. Again, how much you pay for job seeker allowance is much broader than the retirement system. So that's another area that we can't really go to, except to say that for these people who are involuntarily retired, they are at risk of poverty.
I think certainly closing some of that gap between job seeker and age pension would go a long way to solving that problem. It's certainly something that Grattan
yeah, and you know what? It's not a simple issue, though. If you said to those people who were involuntarily retired to have the full age pension, you automatically create an incentive for people not to want to continue working, which is not in anyone's interest, the individual or the economy. So finding the right balance between those things is quite challenging.
It is indeed, although I'm not sure that, or at least the old rate of job seeker struck that balance very well. But Brendan, let me come to you on that issue, and particularly of retirees that don't own their own home. We had quite a popular question from Kobe Maglan saying, if an increase in Commonwealth rent assistance isn't the solution, what is the solution? Do you think that increase in Commonwealth rent assistance is important? And Deborah did say it was important, I should point out. And do you think there is anything else we should be doing for that group?
Yeah, well, Danny, I think the short answer is, if you think about the pension for homeowners who are max rate pensioners, on the whole, they're not living an extravagant lifestyle, but they're not in poverty. They tend to be in less financial stress than working age Australians. And so why is this? They've got very little private savings, so very little private income. It's because the age pension is adequate for that group. Rent assistance is essentially a supplement to the age pension for retirees, but the rate is not adequate for that cohort. The gap, to people are typically spending 30% of their income on rent. And that means, whereas rent assistance is only something like $3,500 a year for a single. And so unsurprisingly, a 40% increase in rent assistance, which is something we've also recommended, is probably not enough. So I think the answer is, there are two ways to make housing cheaper or more accessible and affordable for low-income retirees. One is to increase income support. So you're probably going to have to do a bigger increase. Now, it's not within the review's purview to go model 100%, 200% increases in rent assistance. That obviously comes with enormous fiscal cost. But it does suggest that you need a larger increase if you're going to help people who do not need to be necessarily in social housing, aren't at substantial risk of homelessness. That's another system entirely. You probably need a bigger increase. It's going to cost more money. It's the big challenge, I think, that the review shows. The other side of the story is you can make housing cheaper. Now, that's something that Grattan has written on extensively. If you fix the planning system to allow more housing in inner and middle ring suburbs, you can substantially reduce rents. And if you did that, then the gap between what people can afford to pay and the income they have would go down. But even then, I suspect you're still talking about an increase in rent assistance that's much larger than 40%, if you are serious about trying to solve that problem for retirees that rent.
Thanks. Deborah, it would be remiss of me not to pick up on the point about gender inequality, retirement incomes, and it was another point that Kobe Maglan made. You didn't go into a huge amount of detail in the review about how you might go about tackling that issue. Why did you sort of not go there?
Well, we did. We had the thing about superannuation is how much you end up with at the end of the day is really largely the result of how long you're in the workforce and how much you were paid. And I think that there are some things that you can do to improve and to close some of that gender gap. Again, where this starts is a gender gap in pay. And again, that's not something we can go to. We also can't, within a retirement income system, go looking at affordable and accessible childcare too, which could have something to do with that as well. So our remit is really to look at the balances on a gender basis. And I've got to say, this is probably the most exhaustive modelling of women in retirement income that's ever been done. Every chapter has looked at women versus men. We built a separate model, actually, just to model outcomes for women based on ATO, ABS and HILDA data. We looked extensively at different kinds of career breaks, how many children you had, how long you're out of the workforce, how that impacts. And there are a number of things that you can do. And as I mentioned before, what I found surprising was the gender pay gap goes to a lower super gap, which goes to a lower retirement income gap because of those settings. One of the most obvious things is the threshold of only $450 per month. Anyone who's earning $450 a month from one employer doesn't get a super contribution. And I think that was really a legacy of paper transactions, but now everything is digital. It's hard to see why you would keep that rule in place. And it's, I think, something like 63% of people affected by that are women. So that would help to some degree. Also paying parental leave on the SG on parental leave would help. And one of the things I found particularly interesting is that on divorce, and only about a third of cases, is superannuation actually divided. And we did really extensive modelling looking at people post-divorce. And whereas men tend to get back their financial position relatively quickly, women, particularly women with dependent children, take a really long time to recover from divorce. And that's quite a simple thing. It's already been recommended in 2018 that the family court should be able to have transparency to see into two divorcing partners' superannuation account. It's not really a very big deal, but it would just ensure that there's a better outcome for women there. And what the research is showing is that many people who've been through a distressing divorce will throw up their hands and say, look, I just want to get out of here. I don't want to know about the detail. So because it's kind of complex, that's unfortunate. So we kind of really support that move to have a more transparent view of superannuation. But overall, what we can see that women's working lives have really increased. In 1980, women had 24 years of work, whereas these days it tends to be more like 38 years. So that gap in what women are earning is getting less and less over time. But there are things that can be done, and they don't make huge differences in dollar terms, but they certainly do improve the equity of the system.
Fantastic, thanks, great answer, and a very important reminder, I think, of the importance of what's happening during the working life and narrowing some of those gaps. We've certainly done a lot of work on more affordable and accessible childcare and the role that could play.
But interestingly, Danny, women make more voluntary contributions than men. And as a person who returned after a career break, I can relate to that. So keeping that bit of flexibility in there to catch up is important as well.
That's a really great point. I just wanted to come quickly back to the tax concessions point that Brendan threw out on the table before, Deborah. So just to repeat it for those that might have missed it, super tax concessions are projected in the review to grow so much they'll exceed age pension expenditure by 2050. If that is the case, what's the point actually of providing those tax concessions through superannuation?
Yeah, well, what we know is that tax concessions generally don't provide a huge incentive to save more. What's probably an incentive for higher income earners is the tax preferred status of being somewhere to put your wealth. And over time, we have seen some really large super funds develop. And as we say in the report, there are now 11,000 funds with more than 5 million in them. And that means that those earnings tax concessions, contributions tax concessions, we don't worry about. That's all pretty sustainable. But the earnings tax concessions on large accounts are really quite not particularly sustainable over the longer term. But the thing that will impact on that is the changes that were introduced in 2017 to limit the amount that people can contribute to super, and also to bring in the 1.6 cap on tax-free earnings in retirement. And what we have seen since then is a very substantial drop in voluntary contributions. I think in SMSF, something like 70% fall in voluntary contributions after that. So we're going to see a levelling out, and those large balances are something of a legacy issue. Once those people pass away, those funds will dissolve. They can't continue on as large funds. So I've seen people suggest a couple of things to reduce those earnings tax concessions. We, of course, noted the facts around this, but didn't make any recommendations. I heard Michael Rice suggesting, for example, that the limit you hold in super should be 3.2 million, so double the 1.6. Or perhaps imposing a higher earnings tax for people over a certain level. That's what some of the stakeholders have said. But it is a concern that is the only part that looks a little bit unsustainable going into the future.
Thank you. Brendan, we're going to have to wrap up in a minute, so why don't I ask a nice big question for you to finish on. Where do you think the review takes us in terms of policy? As Deb said, they were there to make the fact base. Where do you see the policy debates coming out of the review?
Thanks, Danielle. Look, I will note that this question is an invitation for me to say that the review confirmed all my priors and that my prior research agenda is obviously the way forward. Look, I think the review hopefully can settle the factual nature of some of the debates around the trade-off between super and wages, around the adequacy of retirement incomes. I think the review is largely a good news story in that respect. But the real holes, I think, that the system now really appear to be about gaps in the social safety net itself. So I would observe that the big problems aren't probably in super. I think the big problems are in gaps in how the safety net works. So we talked about renters. So obviously the rate of pension available to renters appears inadequate. We've talked about those that retire early. Going back a couple of decades, the part of the system that helped people there was the disability support pension. It was much easier to get access to that. And we saw after the 1990s recession, many people who were in manual labour jobs ended up on DSP. Now that's been tightened substantially. Access to it, particularly for musculoskeletal injuries. And the net effect of that is far fewer people between the ages of, say, 55 and 65 end up on the DSP. And instead, they end up on JobSeeker, which is a much, much lower rate. So I think a lot of the big holes in the system are actually around making sure that pension safety net, the social safety net, is there. And I think the thing we really need to be conscious of as going forward is, universal super is a good thing. It's generated a compulsory system has generated savings that are helping people have higher retirement incomes, but it does generate this large constituency that tends to skew the discussion towards super. $3 trillion in assets under management. We saw this in submissions to the review, and I think the review is a timely reminder that the retirement system is much more than just super today and going forward over the next 40 years, and that's a good thing. And where the holes, in my view, are largely outside of super, they're in how the social supports actually operate.
Fantastic. Well, that's a lovely note to finish on. I want to say a huge thank you to Deborah again for the review and for being here with us today, and to Brendan as well, of course, for sharing your expertise with us. Thank you to everyone that attended. Fantastic level of engagement. As predicted, I wasn't able to catch up with all those questions, but really enjoyed that there was a lot of back and forth going on there in the Q&A, and I hope we at least answered some of them for you. This is not our last webinar for the year. It is our last webinar where we'll talk about retirement incomes, but next Monday evening, I'll be co-hosting what will be our final webinar for 2020 with broadcaster Geraldine Doogue. We're going to be discussing the 6 books that Grattan recommends for the Prime Minister to read on the beach over summer. So we've released the list today. There are some really fantastic topical reads on there. I'm excited to say that several of the authors are going to be dropping in to the event to discuss their work. So if you're interested in checking out that list or in registering the event, please go to the Grattan website. I'd also encourage you to sign up for the Grattan newsletter while you're there. Our bumper Christmas edition is still yet to come for the year. And if you like the contribution that we make to the public policy debate in Australia, please also consider donating. It has been a tough year for Grattan, as for all not-for-profits, to raise revenue, and we really rely on your ongoing support to keep doing what we're doing. Big thank you to all of those people that already support us. We really appreciate having you in the Grattan community. So thank you, everyone. Have a fantastic afternoon, and hopefully I'll see some of you on Monday.
Thank you.